Thank you very much for being with us. Appreciate your time.
Thanks for having me.
Let's just start right there. Just in terms of the overall real estate market on the commercial side, what you've seen and what you expect to change about it as we go forward.
Well, the big picture fundamental landscape is, generally speaking, strong for real estate. You have interest rates lower for longer. On the public REIT side, you have historically high spreads between cash flow yields and investment grade bonds. I think it's 260 basis points versus historical records of 96 basis points. Bonds, you get no yield. So real estate is an attractive alternative. I think Preqin estimates there's $300 billion of in-place capital and sovereign wealth funds and private equity funds ready to invest in real estate. But, and it's a big but, to your question, there's a great deal of disparity because of the pandemic and the economic ramifications between real estate property types. So you have winners and you have losers. Winners include single family rental housing. Winners include industrial real estate. Industrial is a new retail. We can come back to that if you like. Winners include manufactured housing communities. Winners include Sunbelt apartments. Losers, to your question, include retail, include office, include hotels, and include coastal apartments, gateway cities. So you have winners and you have losers.
And when you look at some of those losers, are there places where they start to get attractive to you in the sense that they may well turn around at some point and the entry point gets valuable?
Well, some are shorter term, some are longer term ramifications. Certainly, we think the pain in retail is going to be greater. What's happened through the pandemic just accelerated that which was going to happen inevitably. E-commerce as a percentage of total retail sales has went from 15 to 25% in the pandemic, probably going to be 30% next year. That was going to happen inevitably. Hotels, you get a vaccine, you're going to see a big spike back in hotels. But people got used to using Zoom, so business travel may be permanently lower, or not permanently, but the trends may be lower in hotels. Office, we already had a 20-year reduction in demand for office space. The lawyers don't have law libraries anymore. Deloitte built new buildings in Toronto and Montreal. They went from 300 square feet per employee to 160 square feet per employee. Those secular trends were already in place. Now, when you've had the CEOs of Bank of Montreal, Goldman Sachs, Morgan Stanley, Twitter, Facebook, Shopify, etc., all come out publicly and say their workforce has worked very well in a work from home environment. Our long-term demand for real estate is going to be lower. I believe them. And so the longer term implications for office are not particularly attractive.
So let's talk about that, because a lot of the office REITs have held up because those giant anchor tenants still pay their rent, whether they're there or not. But at some point, and I don't know how long, what the rolling dates will be, but those leases or contracts will come due, and some of them will fall off. Now, when we talk to the REITs, they maintain they whistle a happy tune, Jeff. But is there a cliff ahead for some of those big players?
Well, the U.S. office REITs certainly have come down a lot more than the Canadian ones, and they've been underwriting some of this precipitous fall. I mean, we believe, net effective rents, which is the face rent less the free rent and the tenant inducements you pay to the tenant to get them to sign a lease, are down probably 20-25%. And so the REITs are underwriting that, and, we think it's early. The Canadian REITs have held up better. Some of them have been trading at bigger discounts to net asset value to begin with, which is why they might have held up better. But there's a much more diverse array of REITs in the United States, and they've come down. Some of them are going to come down more. We think the pain is somewhat early in this regard. But you have winners. Go ahead.
Go ahead.
I was going to say you have winners. I mean, you have single-family rental housing, which is a home you can rent between 1,100 and 1,800 square feet in the Sun Belt. You pay between $1,200 and $1,900 a month rent, so it's lower rent per square foot than an apartment. You get a backyard, you get a driveway. They're typically families for the local school district is making the decision, and they're getting a boost from the pandemic because there's a transition from apartments away from a common area away from an elevator. There's probably a place in the back of that house where I can have an office, home office to work from home. So they're getting a boost. So names like Tricon in Canada, Invitation Homes, and Sun, or not Sun, that's manufactured housing communities, but American Homes for Rent. These are great names. Industrial real estate. Again, we've been talking about this with you for years. Industrial's the new retail. They've been getting the boost from the e-commerce activity. But what's changed is we have two new, powerful secular forces benefiting industrial real estate. The first is onshoring. We met with one of the chief economists of one of the Canadian banks. Not only does he agree with us, he quantified it. He believes 20% of all U.S. imports from China will become manufactured onshore. That's a big number. And we don't think it's inefficient, unproductive like it's been for 2 generations. It's going to benefit from automation, robotics, artificial intelligence. The second is, Nike will still make shoes in China or Cambodia, Vietnam. But when I was in business school, the big buzz phrase in operations class was just-in-time manufacturing. Just-in-time manufacturing is done. It's now just-in-case manufacturing. Nike will still make shoes over there, but they'll have redundancy in the supply chain and additional inventories here. Canada could rely on the United States to get our masks from 3M over the border. Does anybody want to rely on China for our pharmaceuticals?
We got to leave it there, Jeff. I feel like, though, I could drill you on some very specific investing ideas based on those themes. So let's put that in our pocket and get you back soon so we can talk through how you're playing those big picture themes. It's always great to have your view on this stuff. Jeff Olin, CEO of Vision Capital. Thanks.